Welcome. This is Professor Milligan, and today I'm going to show you and teach you how to read financial statements. Let's get started. We're going to start with an income statement. An income statement shows how income and expenses came in and went out of a corporation over a period of time. So if you see them say it's a quarterly income statement, it shows the income and expenses that happened during the quarter. An annual income statement will show the income and expenses that happened over the entire year. I purposely chose financial statements from a corporation several years ago, and I purposely chose to keep the name of the corporation off. I'm not making a recommendation here. What I'm doing is I'm teaching on how to read financial statements. Now you're looking at the top half of an income statement. The top half of an income statement is known as your operating leverage. The top part of an income statement is known as your operating leverage. This is a corporation's ability to manufacture and make more product based on demand. The top line of the income statement is your revenue. You'll also see it called sales. This is all the revenue or income from operations. From that, you'll see there's a cost of revenue. You see it also called cost of revenue, cost of goods sold. This is what it costs them to actually produce the revenue that they generated. You take your total revenue, subtract your total cost, and what you're looking at is your gross profit margin. This particular corporation's revenue for the last 3 years has grown at a compounded annual growth rate, also called CAGR, compounded annual growth rate, also called CAGR, at 56%. This is a young company, startup company, and you're seeing tremendous growth in revenue. The other thing that we're looking at now is if you take your gross profit and divide that by your total revenue, you get your gross profit margin. You can see that the gross profit margin for this corporation was at 73%, then it increased to 76%, then it's almost to 83%. What this basically is saying is for every dollar in sales, every dollar in revenue, you're looking at 82 cents on the dollar in terms of gross profit margin. So this corporation, actually, their profit margin is increasing. This is actually a very positive sign. Total revenue. This comes from your total sales. These sales can be cash or credit. Subtract total cost of revenue from total revenue, and you have gross profit. That's your gross profit. Divide your gross profit by the total revenue, you get your gross profit margins. Now, underneath this, you'll also see there's operating expenses. Now, these operating expenses are basically the expenses that they use in terms of running the business. Now, for this corporation, they're spending, as you can see, a tremendous amount of money on R&D, research and development. So they're spending money on developing new products, new services. That's a major expense for them. The other major expense for them is their selling and admin expenses. So you'll see that called selling general administrative expenses. Included in that is your HR costs, salaries, rent, if you're paying rent. Those are the expenses. Advertising, huge one. These are the expenses that the corporation pays to run the business, operations, expenses to run the business. Now we get down to our operating income. Operating income is the income generated from the corporation's operations less the expenses to run the corporation and generate those revenues. That is your operating income. Now, also for some corporations, it could be operating loss. This comes from operations. Now, if we take our operating income and divide it by our total revenue, we get our operating margins. You can see that, again, that their growth rate and their operating income has increased by 204%. It's a CAGR of 204%. As you can see, operating income went from $538 million to 4.5, almost $5 billion. Your operating margin, which is calculated by taking your operating income and dividing it by your total revenue, you can see that it's going from 10.5% to 35% to 40%. So again, for every dollar in revenue, they're generating 40 cents in operating margins. So that's how we read the top half of the income statement. This is the top half of the income statement, again known as your operating leverage. Now what you're looking at is the bottom half of the income statement. The bottom half of the income statement is known as your financial leverage. This is where we see how the corporation raised capital to run the business. You have your three major stakeholders in this section, as well as a fourth silent partner. You are now looking at the bottom half of an income statement. The bottom half of the income statement, the first group of investors that comes up are bondholders. You can see that this corporation, the interest expense is the interest that is paid to the lenders of the corporation. The bondholders are any long-term debt. That's the interest expense. Now you can see that this corporation has zero interest expense, which leads us also to say that the corporation right now is not paying any interest expense on any of its debt. The next stakeholder, which is our silent partner, is Uncle Sam. You can see right now that we're taking out our income tax expense. So a couple things to note here. One, interest expense off of debt actually lowers a corporation's taxable income. Now in this particular corporation, they have no debt, so therefore there's no interest expense. But again, you can see that interest expense will lower a corporation's taxable income because it lowers their taxable income before they take out taxes. Your income tax expense belongs to Uncle Sam, your silent partner, and this particular corporation has a minority interest. Our second stakeholder in the corporation is preferred stockholders. Now, this particular corporation has no preferred stock, but if they did have preferred stock and they paid dividends on those preferred stocks, those dividends would be taken out of your income right here. So again, if the corporation did have preferred stock, the dividends on those preferred stocks would be taken out right here. Then we get to the bottom line of the corporation, and the bottom line belongs to the common stockholders. So you can see here that, again, as we did some calculations, the compounded annual growth rate right now in terms of net income is 856%. We all know that's an unusually large number that you won't see, but you'll see this with startups. And the reason why you'll see it with a startup company is because they go from one customer to 100 customers to 1,000 customers in a very fast pace in a lot of cases. This corporation is no different. So you'll see they went from $32 million in terms of revenue, and 2 years later, they're basically at $3 billion in terms of net income belonging to common stockholders. Net income belongs to the common stockholder. This corporation, I'm almost positive, does not pay any dividends on its common stock. Therefore, all of the net income is going to be added into retained earnings. Now, the bottom line you'll see here is your net profit margin. Net profit margin, again, is taking your net income divided it by total revenue. So what this first one says in 2012, what this shows you in the first year, they generated 0.63% of 1 cent for every dollar in revenue. Now, the second year, it jumps to almost 19 cents for every dollar in revenue. And in the following year, it jumps to 23%. So in other words, for every dollar in revenue, they're getting 23 cents in terms of net profit. That is actually, again, a very good profit margin. But we need to compare this. Margins and ratios by themselves tell you nothing. So you can see that one is this net profit margin is increasing every year. So that's positive for the corporation. Now, the other thing I would do with this is I would take this net profit margin and compare it with a competitor or the industry to see if they're as good as industry, better than industry, worse than industry, but to see actually where they are. This is your income statement. This is one of your major financial statements that we use to actually value corporation. Now, before I jump from this, if you take your net income and divide it by the number of shares outstanding, you'll get what's known as earnings per share. And as I've told you guys many a time, Wall Street loves to value businesses based on earnings per share. So that's the reason why I'm showing you this. You can see the growth rate and revenue, which is also is going to translate to a growth rate in earnings per share. I'm going to go to my statement of cash flow next. I think this is one of the most overlooked, underused statements, but I think it provides a lot of information about the corporation. A statement of cash flow shows how cash came into the corporation and how cash went out. As you look at this statement, I'm going to say a couple of things to you. One, anything that brings cash into the corporation is going to have a positive sign. Anything that pulls cash out of a corporation is going to have a negative sign. For instance, if a corporation pays dividends, those dividends are an outflow, they're going to show up on the statement of cash flow as a negative sign. If a corporation borrows money, they go to the bank and they take out a loan, that's going to show up as a positive on the statement of cash flow because the corporation is taking cash in. Anytime the corporation takes cash in, it's positive. Anytime the cash goes out, it's a negative. This is a statement of cash flow. Now, the top part of the statement of cash flow is cash from operations. You can see here that cash from operations went from 1.6, and again, this is probably billions, and this is also an annual statement, 1.6 to 4.2 to $5.4 billion. We can go up top now, and we can see how this money was spent. Now, depreciation, the first thing that shows up, is a non-cash item. Corporations do not write a check to the IRS for depreciation. Depreciation is used to lower your taxable income off of capital assets that have a depreciable life. Now, I know that's a lot of statement for those who don't understand balance sheets and income statements, but depreciation is IRS's way of allowing corporations to write down the value of an asset as they use it, as it gets older. It's cash that they have, and that's why depreciation is a positive on your statement of cash flow. Changes in accounts receivable. You'll notice that your accounts receivable number is negative, a negative 170, a negative 378,000, a negative 610,000. What this tells us is that the corporation sold more items, generated more revenue, but from an accounts receivable standpoint, they did not get the cash. That's why these are negative signs. So if accounts receivable increases, that means it's not cash they're taking in. If accounts receivable decreased, we had a positive here. It meant that they actually got the cash from it. So you can see that the accounts receivable is growing. The next thing you'll see is changes in liabilities. Liabilities are short-term money that the corporation owes to vendors or other entities. And the reason why they're liabilities, they typically come due in the next 12 months. They're short-term, they come due in the next 12 months. You can see that the liabilities have gone up, 134,000 to 841 to 687. What this tells us is that they're doing more and more business in terms of current liabilities with vendors. So you'll see that the total change in operating activity, and then you'll see what the bottom line number is. Now, the reason why I'm pausing here is because this is the cash being generated from running the business. The next section, which is your investments, shows how the corporation spent cash, where cash was spent. Now, the first item in this section is called your capital expenditures. Capital expenditures is a corporation's investment in long-term fixed assets, also known as plant, property, and equipment, as well as what they spent to maintain that equipment. Capital expenditures is where the corporation spends money to buy new equipment, plant, property, and equipment, and the money they spend to maintain that equipment. In most corporations, CapEx is negative because the corporation is spending money for those capital assets. For most corporations, their most profitable assets are their long-term capital assets. This is where they make the bulk of their money. This is where they get their best returns. Now, underneath capital assets, you'll see investments. Investments in this case are investments in terms of securities that they might buy and put on the balance sheet, Or it could be an investment in a subsidiary. They could have brought another corporation. They could have brought another division. They could have expanded. That's what investments are. Now you notice in 2014 that number was a positive $1.2 billion. What that means is they probably sold some of those short-term investments that they have, and that's why that's a positive number. So in 2012 and 2013 in investments, the corporation actually spent money. They brought those investments. In 2014, they sold some investments and reaped the $1.2 billion. The other thing now on the bottom, you'll see that other cash flow investment activities, those could be anything. Again, it could be them buying a business, it could be them selling a business, starting a new division. It could be a number of things. This is when we actually would go into the annual report and read the footnotes to see exactly what that is. Because you can see in 2014, that's $5 billion that was spent. One of the major reasons why I like this section, you can see that in 2012, they generated $1.6 billion in revenue or cash from operating activities. In 2012, they generated $1.6 billion in cash from operations. But in that same year, they spent over $7 billion. Now, $1.2 billion was used towards CapEx. They took 4.8 billion and put into short-term investments. If we took out those short-term investments, as you can see, the corporation basically spent a little more in terms of investment activity than they generated from operations. Now, in 2013, you can see that they generated 4.2 billion in cash from operations. They spent 2.6 billion. Love seeing that. And again, if we take out the short-term investments, you can see that, and you can look at what they spent for CapEx. And then the third year, 2014, you can see again, 5.4 billion from cash from operations and 5.9 billion was spent. Of that 5.9, 1.2 billion came from investments. So they sold that, so they got that. But then there's that $5.325 billion that we're looking at. And I don't know where that came from. So this is where I would actually have to go investigate. The bottom part of the statement of cash flow is financing. This shows how the corporation raised capital, how money was brought in, and how money was sent out in terms of financing. The first one on the list is dividends. This corporation has no dividends for preferred or common stock, so therefore dividends is zero. If they had paid out any dividends, those would be negative numbers. Now you see here in 2012 that they sold stock and they took in $6.7 billion. Looking at this, that $6.7 billion came from the fact that this company probably was an initial public offering and the company just went public. You can see that huge amount of cash from sale of stock. You can also see in 2013, they actually also sold some more stock for $1.5 billion, most likely a secondary offering. And in the 14th year, you can see it drops down to $18 million. What else are we seeing here? Net borrowing. Understand net borrowing. If they borrow money, it's going to be a positive for the statement of cash flow. If they retire debt, it's going to be a negative. So you can see right here that our net borrowing is positive, which means that they borrowed more money than they retired debt. But you can also see that in 2013, they retired $1.8 billion worth of debt. And in 2014, they retired a $243 million worth of debt. That's why those two are negative. Now, other financing activities, again, they could be buying back stock. There could be some other activities, but you can see that that's what it is. And then you can see on the bottom line, for total cash flow from financial activities, in 2012, they raised $6.2 billion. In 2013, they spent cash-wise $667 million. And then in 2014, they took in another $1.5 billion. We get down to the bottom line. And the bottom line statement of cash flow is the change in cash. So in 2012, cash increased by $872 million. In 2013, increased by $939. And in 2014, increased by $992 million. I know I'm redundant here, but I got to emphasize a couple of things. We can see how cash came in. We can see how cash was spent. And we can see what the corporation is doing with the other excess cash in their financing activities. Now, for some corporations, this is a young corporation. This is a young corporation, which you can kind of tell they're taking as much of the cash as they can and putting it back into the business. In this financing section, for corporations that, I don't want to put any names out, but I'm going to put a name out here. Let's say Apple. Apple's generating so much cash that down here in their financing activities and cash flow provided, total cash flow from financing activities, you'll see that they're paying out dividends. Also in this section, you'll notice with some of these corporations that they actually are buying back stock. So you'll see stock buying back. You'll also see stock buybacks and dividends. This section lets you know what the corporation is doing with their excess cash. What kind of stewards are they? Are they putting the money back into the business, retained earnings? Are they paying out in dividends? Are they retiring stock? Some of these major Fortune 500 corporations have low growth. They're mature companies, but tremendous cash flow. You'll pick it up here. You'll see cash flow from operations. You'll see the investment activities, but you'll also see the financing in terms of where and how they're using that cash. Statement of cash flow. The third financial statement we're going to look at is a balance sheet. A balance sheet shows the assets, liabilities, and the net worth of a corporation for a specific moment in time. So if this was generated at the end of the year, December 31st, then what this shows is what was on the balance sheet as of December 31st. Again, balance sheet shows a moment in time. When you're looking at a quarterly balance sheet, it's looking at the last day of the quarter. What we're looking at now are the assets from the balance sheet. You have your current assets. Current assets are assets that can be or will be turned into cash in the next 12 months. All right, short term, in less than 12 months, these assets, these current assets can be turned into cash very quickly. Now you'll see that they have cash and cash equivalents, but underneath that is short-term investments. Short-term investments are a non-operating asset. This is where the corporation is just taking excess cash that they have and they're putting into some type of short-term investment because they don't need the money right at this moment, but they are trying to earn interest on that money until they need it. Now, here's what's interesting about cash and cash equivalents. Of all the assets for a corporation, cash typically has the worst return. Let me say it again. For most corporations, cash is one of the worst returning assets that you can have. This is the reason why you see that they put money into short-term investments. Now, the capital going into short-term investments, I would say, based on what we've seen so far from the statement of cash flow, an income statement, but basically the statement of cash flow, is coming from the sale of these securities, from them actually taking the company public. Next, you'll see net receivables. These are the receivables. These are accounts receivables. This is items that they've sold but have not yet been paid for. Inventory here is zero. So what this tells us is that this corporation is not manufacturing. This corporation is probably doing some type of intellectual property along that lines. There's no inventory here. We also have our long-term assets. For most corporations, their long-term assets is their plant, property, and equipment. And for most corporations, long-term assets are their most profitable assets. All right, plant, property, and equipment is where they generate their best returns. These last two items I have circled here on the balance sheet under long-term assets are goodwill and intangible assets. Now, the reason why I circle them is this. Goodwill is a non-performing asset. Goodwill generates no revenue, no income for a corporation. Goodwill is the difference between what a corporation purchased another business for above its book value. Let me give you an example. Let's say that we're going to buy another business, and let's say that we're going to pay $1 million for that business. As we put it on our balance sheet, the book value of that business, what the balance sheet shows the value of that business is $750,000. We paid $1 million. So if we put that on our balance sheet, we don't balance because what we paid for it and what the assets are worth, there's a gap of $250,000. That $250,000 is goodwill. That's what goodwill is. Goodwill gets on the balance sheet from when a corporation purchases another business, and they pay more than what the assets are valued at on the balance sheet. The other item you see there is intangible assets, patents, copyrights. They have a value. If the corporation is the nature of their business is to sell their intellectual property, license it out, then intangible assets is an operating asset. If the intangible asset itself is just something that's kept on the balance sheet from some intellectual property that they have, but they generate no royalty, they generate no revenue from it, then these patents and copyrights are a non-operating asset. We get down to our total assets. Total assets right now are valued at 15 billion, 17, almost 18 billion, and then 40 billion. That's your total assets. Now, the other thing that we know with the balance sheet, and that's why they call it a balance sheet, our total liabilities and owner's equity section needs to equal our total assets. They need to balance. We are now in the liabilities and owner's equity section. In this section, in our liability section, we have our current liabilities. These are liabilities that will be paid off in the next 12 months, if not sooner. In most cases, this is money that's owed to vendors, and these accounts payable is non-interest bearing. In other words, there's no interest being charged on these liabilities, accounts payable. There's no interest being charged on these accounts payable. Underneath accounts payable, you'll see short/current long-term debt. These are not current liabilities. They're in the current section because they're going to be paid off in the next 12 months. So they are current. But these are interest bearing. This is current debt. Let me repeat this. This is important to understand. Short/current long-term debt is not a current liability. It's in this section because this is what comes due in the next 12 months on our long-term debt. This short and current long-term debt is interest bearing. In other words, there's interest being charged on this amount of debt. And underneath that, we have our current liabilities. Our total current liabilities are going up. And by the way, make sure you understand this. If our accounts payable is increasing, it means that we have non-interest bearing capital that we borrowed from our vendors. Let me explain what I mean by that. Let's say in our business that we have a certain vendor that vendors that we pay every 30 days. As we increase the number of vendors, we're basically getting a 30-day loan on that capital. It's money that we're not having to pay out to pay our vendors. As we increase the number of vendors, as we sell more and we increase the number of vendors, you can see that the accounts payable has gone up. It's a non-interest bearing, and the way I view it is a non-interest bearing short-term loan. 30 days, 60 days. Another one that you'll see is wages payable. Wages payable. If you've ever had a job where they say you're 2 weeks in the hole, so you work 2 weeks and then you start getting paid after that. So they're going to hold your first check 2 weeks in the hole. You are actually loaning them an accounts payable. You're loaning them a short-term loan with non-interest bearing on your paycheck. You also have our long-term debt. You can see here, our long-term debt has gone from 1.9 billion to 237 million down to 119 million. So long-term debt's been actually reducing. But there's your long-term debt. And again, interest bearing. Now you see there's other liabilities. Once again, you have to go into the annual report or go into the footnotes in the quarterlies to figure out or find out what those other liabilities are. They have to identify them. You can see again that a significant dollar amount there in other liabilities. It's in the last year, 2014 there, it's 2.5 billion. It's greater than your accounts payable. So what is that? We need to go find that out. And since it's in our long-term section, it's a liability that's not coming due in the next 12 months, but what is it? What you're looking at now is the owner's equity section of a balance sheet. In here, you'll see preferred stockholders. In this case, the corporation has no preferred stockholders. That's why you see zero. And by the way, preferred stock is kept on the balance sheet at par value. In other words, what it cost the corporation, not market value, par value, what the corporation issued at. And par value for preferred stock is also the price that when they go to retire preferred stock, that's the price they're going to retire it at. Underneath preferred stock is common stock. You'll see next retained earnings. Retained earnings belongs to the common stockholder. Retained earnings is increasing. You can see it went from 1.6 billion to 3.1 to 6 billion. Retained earnings is an accumulative account. It starts the day the corporation started the business, and every year, either net income is being added to retained earnings or some portion of it, or if it's a net loss is being taken out of retained earnings. There's some well-known corporations right now, I'm not going to say the names, that have negative retained earnings and had it for several years. And they're some of the most popular corporations in the US. The stocks are doing extremely well. But again, so you can have negative retained earnings and the corporation does well. Eventually, the corporations that I'm talking about, if they keep performing as well as they are, they should turn, and retained earnings should turn positive. Underneath that, you'll see treasury stock. This corporation has no treasury stock. Treasury stock is nothing more than a corporation goes back into the marketplace and buys back its own stock. That's treasury stock. In this case, again, I told you, young corporation, they're not buying back stock. They're trying to get up and running and grabbing market share. Capital surplus. This is a big account. Capital surplus is the additional capital. You'll also see it called additional capital, paid above par value for the common stock, the IPO stock. Let me say it again. Capital surplus is the additional capital paid when an IPO, when the company issues stock above the par value for the stock. If you didn't catch that, yes, stock has a par value. Most corporations have a par value of $1. Some put on there a penny. It's just a number that they have to put on the certificates. It has no monetary value. Underneath capital surplus, you'll see stockholders' equity. This section usually is a plug number. And what I mean by plug, this is typically where they account for currency exchange gains or losses or things of that nature. Again, it's something that you have to go dig into the footnotes in the annual report or to find out what it is. And a lot of corporations, it's money made or lost on hedging against currency or other things that they hedge against in terms of risk of the corporation. So now you guys have heard me say this before. I'm going to say it again. What could a corporation be hedging? Well, the airline stocks hedge kerosene, which is a close derivative of jet fuel. Starbucks hedges coffee beans, coffee prices, as well as milk. Nike hedges rubber. Most corporations are hedging something that's going to have a direct impact on their inventory or their cost. Now, some corporations that aren't hedging, they're actually making or losing money on a currency conversion. So let's say, for argument's sake, that this corporation is doing business overseas in the Eurozone, and the euro has appreciated against the dollar. They go to bring that money back on the balance sheet to show how much money they made or lost, and they're showing this huge profit or gain. Part of that gain is coming from the currency conversion. They will put that in this other stockholder equity. That's where it will show up. All right, that is a balance sheet, and those are the financial statements. I want to thank you for viewing my video on how to read financial statements. You can follow me on my Wall Street Wednesday. I'm on live on Instagram every Wednesday from 1 to 2 p.m. Pacific Standard Time. And I also, as you guys know, post my videos and post a number of videos on my YouTube channel. Feel free to inbox me or DM me when you have a question or concern, and subscribe to my page. Once again, this is Professor Milligan, and thank you for your support.